as you just mentioned, central banks around the globe are tightening their monetary markets. How do those policies on the global markets affect the U.S. economy?
They have I think, a very important impact. One of the puzzles coming out of the Great Recession and for the decade that followed was the persistently low inflation in the U.S. And if you looked at the data, you could divide it into goods prices and services prices. The services prices, which are largely domestically determined, reacted a lot like the Fed expected prices to react. They rose as the labor market tightened and they got above the 2% target, and they were continuing to rise. It was goods prices, those things which were more globally sourced and more globally distributed, that just showed no inflationary pressure and indeed had periods of pronounced deflation. With every central bank now tightening, you essentially have that whole global market doing the same thing to control the goods price inflation. And so I expect there to be a much more consistent downward pressure on both services and goods prices, very different than the recent history.